Hi, I'm Tim Laughlin. I'm a director in the Investment Management Division at First National Bank. We like to provide a lot of information to our clients in a variety of ways. Now it's my pleasure to provide this video commentary regarding the current economic situation and our outlook for the months ahead. Undoubtedly, the economy was impacted by the weather, especially in the Northeast. Remember all those storms that hit Boston? Another headwind for the economy was a labor dispute among port workers and the owners of shipping terminals located along the West Coast. These two factors certainly disrupted business activity in the first quarter. But those issues were transitory, and the impact from them has largely passed. The more important factors weighing on the economy were the dollar, which rallied late last year and through most of the first quarter, and oil, which fell sharply last year and continued to drift lower during most of the first quarter. We can see how these factors impacted the GDP on the next chart that illustrates the four components of GDP. The strong dollar substantially impacted net trade. With a rising dollar, our goods look relatively more expensive in the global marketplace. Meanwhile, imported goods look relatively less expensive. As such, our exports declined 7.2% during the quarter, and imports increased 1.8%. The substantial decline in net trade was the largest subtraction in the calculation of GDP during the first quarter. Low oil was also a source of weakness in the quarter. The dramatic decline in oil led energy and energy-related companies to markedly reduce their spending and investment. There was a 23.1% annualized decline in non-residential investment spending. This led to a smaller than expected increase in the investment component of GDP. Oil also impacted the consumer. Ultimately, we believe lower oil prices will be good for our economy. However, oil fell so far, so fast, that it engendered a sense of anxiety. There was concern that falling oil was a canary in the coal mine, a signal that something was terribly wrong in the economy. As such, consumers have reacted with caution and have not yet begun to spend the savings they are achieving at the gas pump. The rate of growth in personal consumption decelerated in Q1. As oil finds a new lower equilibrium and volatility in this sector moves lower, we believe the consumers will begin to start spending some of the savings they are achieving at the pump. This will help boost consumption and strengthen the economy in a more broad-based way. We would not be surprised to see the GDP report ultimately revised to show that the economy contracted in the first quarter, just like last year in 2014. Also, like last year, but to a lesser degree, we anticipate the economy will accelerate and continue to grow in the coming months ahead. Our outlook that the economy will accelerate in the coming months is based on a number of factors. For example, the consumer is doing better. The consumer is doing better because the labor market is improving. Over the last year, the economy has averaged adding about 257,000 new jobs per month. The unemployment rate is down to 5.4%. Average hourly earnings are up about 2.2%. The wage increases have been subdued, but with 3 million new workers added and wages up, there's certainly more buying power and capacity to help increase demand, which will help the economy grow. One of our favorite statistics to track is real disposable income. This is key to our economy because it represents the money that consumers can spend and save. As you can see, real disposable income, as represented by the blue line, is trending in the right direction. The business sector remains relatively strong. We follow the ISM reports. The reports are produced monthly. One report measures the outlook in the manufacturing sector, the other in the services sector. Both reports have consistently been above 50, and a reading above 50 signals expansion. The services sector index has averaged 57.3 over the last 12 months. This is the best 12-month average since 2006. Manufacturing, which had been falling mainly as a result of troubles in the energy sector, has leveled off and showed a slight increase in the most recent report. The consistent readings above 50 lead us to believe that spending in the business sector will accelerate. Finally, we are hopeful that the progress we see in the global economy can be sustained. According to the IMF, relative to last year, the global outlook is improving. And as you can see, the leading indicators associated with G7 countries is trending slightly higher. One anecdote that the global economy is improving is that oil has been moving higher, and the dollar's gain has backed off and paused a bit more recently. As noted, the strong dollar and oil had been headwinds for the economy, so a modest reversal of these two trends, as long as the reversal is not extreme or disorderly, could be good for growth in the coming months. We don't see inflationary pressures building in a way that would be destabilizing. And the deflationary scare that had been a slight concern also seems to have passed. The most recent core CPI was 1.8%. Given the current economic outlook, the Fed may raise rates in 2015, but at this point, the Federal Reserve is totally data dependent. Regardless of when the Fed moves rates, they will be slow, careful, and cautious in adjusting monetary policy. The biggest risk to our outlook is that something occurs to severely damage consumer confidence. This could occur because of geopolitical difficulties, like a re-escalation of tensions between Ukraine and Russia, or more difficulties emanating from the Middle East. If Greece were to exit from the euro, and that did trigger an economic setback in the Eurozone, that would not be good for our growth thesis either. But what looks like the most realistic expectation is more of the same. Slow, inconsistent growth in an economy that's having difficulty sustaining momentum. In the Outlook piece we published earlier this year, we said we expected 2015 to be better than previous years, but not as good as the long-term average rate of growth for the economy. Given the relatively slow start and the weak rebound, it does look like 2015 may be a little bit weaker than expected, but we don't believe this is the beginning of the end of the expansionary cycle. Thank you for joining me today. Thank you for your interest in our ideas and services. We sincerely appreciate your time.